Hey guys, I'm excited to share this with you. This is a friend of mine, Kathy Fetke, who flew in to Denver to speak to you on market. She's a market expert. She's written books. She's been on all sorts of TV stations, and she has a very famous podcast. So today, what you're going to learn is that the market's about to crash, and you're going to find exactly why and how bad. So without further ado, here's Kathy Fetke.
For real estate investors. If you already thought we had great tax breaks, it just got better. And that is a stimulus. So here we have a directive from above stimulating the economy with tax breaks. More money into the economy is a stimulus, and that tends to get the market booming. And at the same time, we have Fed rate hikes, which is the opposite. It's a tightening measure. So now we have two things happening at the same time: a stimulus and a tightening. And I'm not a historian, so I'm not really sure if this type of thing has happened in the past. Anybody know if we've had tightening and stimulus at the same time, and how that worked out? So that's interesting. Then we also have, in addition to that, these tariffs, and that's driving prices up right now. Now, a lot of people are saying that it's just a tactic. It's one of Trump's ways of negotiating to get a better deal. He's a deal maker, and he doesn't really want tariffs, but he wants a better deal. And so it may or may not result in a trade war. But at the same time, we are seeing prices go up. Anybody seeing cost of labor and cost of materials going up? Absolutely. And some of that may or may not have to do with tariffs. So that's an inflationary measure to have prices going up. That's inflationary, along with the rate hikes. But again, at the same time, the rate hikes are meant to curb inflation. So we're kind of creating inflation, but trying to curb it at the same time. So again, just confusing measures that are happening, and how does that affect us as human beings, as Americans, and as real estate investors? Where is that going to end up? Right now, it looks like, from what I'm seeing, is more inflation. Because again, one more measure that seems to not be making sense is the creation of new jobs. Anybody see where we are on unemployment rate? I have lots of really fabulous. Did you actually get it? Is this working? Did it email? Oh man, this is amazing every time. All right. So, did anybody see the latest unemployment rate? Anybody know what it? 3.8. It's low. It's low. Historically low. And yet, isn't there a lot of talk about creating jobs? But we have so many jobs. We have so many jobs and not enough people for them right now. Anybody having problems with finding the right workers? Right? So, you're hearing one thing, well, we want to create more jobs, but we can't find workers, at least not skilled workers. And there's more and more people out of the labor force. So again, a confusing thing. What does all this mean? And so obviously that's inflationary. When you're down to what some people will call or say just the unemployable, really. At this level of unemployment, these tend to be people that either aren't skilled or aren't employable. And so what we need more than anything is job training, right? We need people to be skilled laborers, and in the meantime, when they're not there, guess what? We pay more. We pay more for labor. So now we have material costs going up, we have labor costs going up, again, inflationary. And yet at the same time, we've got the Fed trying to curb inflation with rate hikes. Guess what? Rate hikes is going to drive interest rates up, which affects our industry. And how much? How much is it going to affect our industry? So we've got positives going on with these awesome tax breaks. Looks like we've got some apartment owners in here. Yep, and short-term. Anyone doing short-term rentals? So the new bonus depreciation is insane. It's just massive tax deductions for us. It's wonderful. Kind of feels a little unfair. In the midst of all this, we already are lucky we get to be own these assets, and now we get even more benefits for owning them. And so again, as a real estate investor, it's a great time. But where do we, oh my gosh, I think he did it. This guy's a genius. I'm so excited. All right, wow. Yay! Now you have to tell me how to use this. Do I just... Back, okay. This one, okay. All right. Thank you. All right. Let's see if that works. Okay, so what we often do, and by the way, if you're not familiar with Real Wealth Network, we have 38,000 investors worldwide. Its membership is free, and we get a lot of information and data. I have always had the Real Wealth Show because I wanted to learn, and I wanted to experience the American dream, and I wanted to stay home and be with my kids and still have passive income coming in. And so I started the Real Wealth Show so I could understand. And so a lot of our education is driven from that place of me wanting to understand and not have any more losses. Did anybody experience some kind of major losses in 2008? Anybody? Because I sure did. I was heavily invested in real estate, and some of our stuff did really well. And a lot of the things I was teaching, the people who listened did really well. But I didn't follow my own advice on some of those things. And I kept 2 properties in California, which I talked about, and I think I might have pictures of. But we bought a house for $540,000. You're starting to see this here, what California's like. You're getting to experience it. I bought a house for $546,000. So excited. It timed it by accident. Then 10 years later, it was worth $1.8 million. And at that time, I was telling everybody to sell California and go trade it for properties in Texas. But I didn't do that. Instead, we kept that house and we bought another one. And a couple of years later, it was back down to $800,000. So we lost $1 million by not listening to my own advice. And at the same time, other people were doing it, and they didn't even feel the recession because they had sold their high-priced assets and bought in Texas, where it was just at the beginning of its boom. So that's why I obsessed with wanting to know what's happening next, because I really don't ever want to go through that again. And I'm 10 years older. I don't know about you, but I'm 10 years older than 2008, and I don't want to go through it again. I'm too old. All right, so this is anybody do a SWOT analysis in your companies? This is a really, really good thing to do. You should do this with if you have a company, every year, go through this SWOT analysis and let your employees help you with it. Do it as a family or as a relationship. It's really a very powerful exercise to do. So we're going to do it here today. To just kind of look at, is anybody else a little confused about where we are in the economy? Like kind of what's next? Because some people are like, you should see the reviews I get. If I mention any of this online or on YouTube, I will get just taken down. And it's okay, I'm used to it. But, there are some people who just only see that Trump is our savior and everything's going to be great. And I would love that to be true. I just want to make sure that we are aware of, what might blindside all of us or what might not be fixable. And so a SWOT analysis will help you with that. So it starts with strengths, weaknesses, opportunities, and threats. So some of the strengths today, and again, it depends on how you look at it, but some of the strengths, look at that U.S. unemployment rate. Really, really very, very low levels, which, again, depending on, all data could be interpreted differently depending on which side you stand. So if you're an employer, this is awful. This is not something you want to see. It means you don't have a very large pool of people to hire. If you are an employee, it's fantastic because you can pretty much ask for whatever you want and pay, and we'll probably pay it because we need workers. By the way, I hope this works, but if you send an email to slides@realwealthnetwork.com, you're supposed to be able to get these slides immediately on your phone. So a lot of times you take pictures trying to get the slides, but you could just look at your phone and see them. All right, Dow Jones. Obviously the stock market's been on a tear. It seems positive, but again, depending on which side you sit, it's how much longer will that go? I know everybody's been asking that. When President Trump was running for office, he said back then, 2 years ago, that it was in a big, fat, ugly bubble, and that it was going to pop, and then as soon as he became president, it took off further, and now it's all great. Everything's fine, and somehow we forgot that just 2 years ago, Trump was calling it a bubble. So what is it today? The housing prices, look at that. We see it's gone past the last high. And while the media likes to talk about this as very concerning, there's some things to look at. We've had inflation, we've had massive population growth since then. So, and areas have changed. I mean, is Denver the same city it was 10 years ago? So how can you, it's not apples to apples. You can't compare Denver prices today with 10 years ago because it's a totally different world and so many different employers and people. And so, you've got to be careful about comparing. Same with Dallas. Is it the same city it was 10 years ago? It's not. So is LA? Kind of. Is San Francisco? Yeah. So when you've seen prices kind of go past highs in those areas, it's a little more concerning because those cities haven't transformed as much as others have. The GDP, it's continuing up and it's doing better. And that, again, unemployment rate down. So lots of strengths, lots of headline news that everything's great, everything's wonderful, and all these new measures are, all these, the tax reform is going to create all these new jobs and so forth, and the deficit's going to, all these things. But here's some of the weaknesses. That this is on the government website, so this isn't information that the government knows this is. $21 trillion in total public debt. Now, during President Bush's 8 years, during his time, the debt went from 5 to 10 trillion. And then during Obama years, it went from 10 to 20 trillion. So it doubled during the Bush era, it doubled during Obama era, and now already up to 21 trillion. So it's a trajectory of debt. It's increasing. And it's really unprecedented, this kind of debt. I don't even know what that, it's hard to even fathom how much debt that is. But if you do take the population of about, 321 million people divided by the debt, it ends up being like, 320,000 or something per person, including babies and elderly and so forth, that we would owe to try to pay this debt off. So when people say, they're going to, basically tax you out of it, they can't. There's no way when the net worth of the average American is much lower than that. So that's a problem. That's a weakness. And then when you add long-term liabilities that really nobody wants to talk about, although it was in the news last week that Social Security is going to run out. Up until that, we haven't heard some of the more negative things for a while. And so to hear that report, it's like, wake up. It's not going to be there for you. If you're under 50, they said you're probably just not going to get Social Security, but you're paying into it, so thank you. For us over 50, I appreciate your money and your investment in my retirement. I'm sorry you won't get yours, but that's why you've got to create your own retirement. But so when you add 85 trillion in long-term, and all these entitlements that supposedly we're paying, there is just no way. It's not mathematically possible to pay these things. So someone's not going to get paid. And you don't want to be that person. So you've got to figure out, Social Security, there's not much you can do. You kind of just have to pay it even if you're not going to get it. But, you just don't want to be the one buying the debt or being the person who's not going to get paid at some point. Because somebody, we can't pay the 85 trillion. Is it going to be the teacher pensions? Who's just not going to get paid when the money's not there? Again, that's why we got to be here taking care of ourselves. Just the 2017 net operating loss of the government was 1.2 trillion. So again, you're not hearing these headlines. What you're hearing is everything's great, right? The economy's booming. But let me ask you, if you were investing in a company, would you invest in a company and say it was doing great if it was losing 1.2 trillion a year? You would not invest, right? And yet people are investing in companies that aren't making any money. That seems to be the trend today. But this is real. This is not a balanced budget. This is only going to add to more debt. And with knowing this, people are investing. They're still buying this stuff. They're buying more debt. $300 billion in debt auctioned off just in 1 week of U.S. debt. Like, people still buy it. Isn't that amazing? I don't know if you are. If you're buying debt, then I hope you understand it better than I do. But I don't know that I would buy a note from someone who is $21 trillion in debt. I don't know if I would buy that note. I don't think I would. All right. Now, debt is going to be a big theme here. These are, again, the weaknesses. 76% of IPOs in 2017 were companies that had never been profitable. Never seen a profit. So it just seems to be the flavor of the day that we don't really need to see profit. It's okay to have a lot of promises. That's enough. And corporate debt is at all-time high. 14% of the 100 largest U.S. companies have interest expenses higher than their EBITDA. And record $800 billion. This was a record right after the tax reform. $800 billion in corporate buybacks this year. So a lot of the talk, this is at least, again, I'm no expert, this is all I'm hearing, is a lot of the talk of tax reform that was going to create more jobs. It looks like actually that money went into companies buying back their stock. So it benefited the stockholders as opposed to creating new jobs. But remember, we don't need new jobs because we're down to such low unemployment. We need job training. We need people to be skilled because we do need workers. All right, so again, some of the things to think about. And this is probably the most concerning, is this CNBC report. I'm sure you probably heard it, but 60% of the country does not have $500 saved for an emergency. 60% of Americans do not have $500 saved. And which really brings to, well, shoot, how many people have that group could afford a house? All right, and then consumer debt, just school debt, is at a new high of $1.5 trillion, and it's considered one of the new subprimes. I'm from California, as you know, and there's two kids, and my daughter just went to college last year, and two friends of hers who come from single-parent families and are really very, very middle class, not wealthy Californians at all, and they both just decided they wanted to go to Boulder, and I get it, Boulder's awesome, right? Great school. But I told my kids, you can go to Boulder if you want to pay the out-of-state fees, because I'm not paying it. Well, her two friends, who really are, I think the mom is a photographer, and the dad, they're not making a lot of money, but those kids walked in and they got full student loans for what is it, like $55,000 if you're out of state. And it's like, our California schools are fine, right? If you don't have money, you go to the local, you just go to your junior college. But it's concerning. Some of this debt and the school debt is, it may default. Now, will it affect the economy the way that mortgage defaults did? I don't know. Probably not as bad. But that's an issue. The biggest issue with the school debt is the lack of ability of these kids to qualify for housing because of their debt to income ratios. And then auto debt, same thing. You just walk in and get a loan these days. There's not much to qualify. Credit card debt, highest ever. So we've got some issues with debt in this country. Just again to be aware of. You can profit in any market. Like I said, the people who listened to me in 2008 and bought in Texas, they did not feel a recession. They were. I'll show you some pictures of that. They were cash flowing while their friends had lost everything. So you can make money in any cycle. You just have to know what's coming to be prepared for it. So what is the opportunity? And this is, I don't know, is there like I don't know, I'm not sure if there's probably like a thing. Anyway, I'll point to it. So this is the U.S. housing prices, the blue line, and the red one was Texas. And then California was like off the chart expensive. So back then, I had, back in, 2005, I got to have people like Robert Kiyosaki on the Real Wealth Show to tell me what was going on, because I didn't understand it. I was a mortgage broker at the time, and I was fairly new to real estate, and I just didn't understand why I could give anyone a loan. It just didn't make sense. Same thing like, how is this going to get paid back? I can show you that this person has no way to pay this loan back. I get flyers on my desk that was called Nina loans. Anybody remember those? No income, no asset loans, Nina loans. Like, really, that was a thing. And then the CISA loans, stated income, stated assets. So, I mean, I could have literally a homeless person come into my office, I could give them a $5 million loan. I wouldn't do that because I believed that I'd go to jail for that, because that is fraud. But you could do that. It was really easy. And if I were such a person to commit that kind of fraud, I could make, a lot of money on that loan. Because we could make 2-3%. It was big checks. And you had to have a lot of self-control back then and know that there's consequences. A lot of people walked away with no consequences, but some did go to jail. But anyway, I was asking, people like Robert Kiyosaki, who had more experience than me, to just explain, what's happening, and just came down to greed and, cycles and get out. He said, I've sold all my California holdings and we're buying in Texas. And the reason was because Texas had stricter lending laws at the time. Lenders hated Texas because you couldn't do these 100% cash outs or 105% cash outs. They had rules because they had been through the S&L crisis and didn't want to repeat that. So selling, I'd sold all their California assets and were buying in Texas. And because it had the highest job and population growth in the country, and home prices were 28% undervalued at the time, as opposed to California that was overvalued. So the bottom line is that you could sell. I had a client who came in and she had 3 of these Stockton houses, old, dilapidated, in crime-ridden areas. They'd always be nickel and dime with repairs and tenants that wouldn't pay. And she could sell. When she came in, we figured out she could sell her 3 properties for $450,000 each. These little dumpy properties, and I had contacts we had already purchased in Texas, so I knew that she could exchange those and buy about 9 brand new properties just outside of Dallas, in this little town called Rockwell. You can't buy a $150,000 house there now, but 10 years ago it was just up and coming. We knew that a new freeway was being built that would connect Rockwell to Dallas, so you wouldn't have to drive around the lake. So instead of an hour commute, it would be like a 20-minute commute. So that's one lesson learned: get ahead of the path of progress, find out what the city's doing, and get in front of that. So we helped her sell these 3 properties in 2005, exchanged them for 9 properties in Dallas. Each property rented for the same, so she tripled her net worth, or her cash flow. She tripled her cash flow and had no more nickel and diming. And she came in and was able to, she just said, I did the thing everybody wants to do. I just turned in my letter and I quit my job, because this one simple transaction tripled her income and she was able to retire, which is what she wanted. So those were the kinds of opportunities you had back then. 2 years later, the houses she sold were worth about $70,000. So that's the consequence of not being able to see what's coming. You've got to at least have an idea of what's coming and be prepared for it. And this is the message I have today, is I really don't know what's coming. I have no idea. I mean, it could be what people, like half the country seems to think we're just going to be on a trajectory towards growth and everything's going to be great and we're going to be the great, great America. We could also have another recession. There's some people who think the next recession is going to be bigger than the last. And we don't really know. But you can be prepared for either scenario. Or you can be prepared to get totally wiped out. Or you can, you've just got to be prepared. So in this case, let's just say that California kept booming and there was no recession. This person wouldn't be hurt either way, right? Either way, she tripled her cash flow. She had really nice homes. She upgraded the homes. She was in front of the path of progress. Those homes in Rockwell you can't get one for under $400 now. So in a place where people said nothing ever happens. I mean, back then people thought we were nuts to be investing in Texas. It doesn't feel that way today because we know what happened. But back then, literally nothing was happening. It was flat. Like you're gonna sell in the hottest market in the country. You're gonna sell from California and buy in Texas, where property values never go up. But we knew they were going to go up because we knew there was job and population growth. So either way, this woman would have been fine no matter which direction things went. That's really what we got to pay attention to. So here are, we're in a different place today. Like I said, population has grown. This is 2008 and this is 2016. So 304 million people. Now it's 324 million in 2016. That's above that. So, over 25 million more people in the U.S. since the last recession. So a lot of times when you see numbers and data, you have to realize, well, there's just more people too. There's more people that might be driving up the GDP or the, when we see higher all-time credit card debt, maybe it's just because there's more people. These are the stats we need to see. Household formations, all those new 26 million people or whatever it is, are forming households. And you've got the millennials who are now graduating, the largest generation today, and they're graduating, they're forming households. So this is good for us. Anyone who's in residential or really anything, you've got more people wanting more housing and spending more money. And at the same time, we have lows in inventory. So more people, more households, very low inventory. These are headlines you see all the time, of course, I'm sure you know. And that combination does what we talked about earlier, creates inflation. So we're seeing prices go up, so much demand, not enough supply, prices go up, rents go up. And then at the same time, interest rates on the rise, so as home prices go up and interest rates go up, it's getting less and less affordable, and we already saw that a lot of people are already in debt. There will be an impact on people's ability to buy, affordability. What does that translate to you? Like I said, everything has a positive and a negative depending on which side you sit. Home ownership down. U.S. lost 1 million net homeowner households in the last 10 years and gained 10 million rental households. So the opportunity, clearly, big opportunity today is to provide affordable housing. I know a lot of you are doing that. And that's just, it's almost impossible for a builder to provide affordable housing with all the things we talked about. We are doing a lot of building, and it's not affordable housing. It's hard with the higher permit fees, the higher labor costs, and the supply costs increasing. So if you can buy an old building and do what you're doing, fix it up and rent it, this is one of the best things you can do because builders can't compete with that. They can't compete. And you can still, with the knowledge you have in this room, you can. You can find properties and fix them up and make them nice homes for people who need them. And so the question is, where are all these people going? Where's the greatest demand? This chart just shows that the dark blue is where the largest number of people are going, and the kind of maroon and then the red is where people who are leaving. So you can see Texas and Florida, super hot markets, a lot of people moving there. Why would that be besides that it's warmer climate and cheaper? What did Texas and Florida both have? Low taxes. You have 10,000 people retiring or turning 65 every day and wanting to retire. And they are going to be on fixed incomes. So when you have a fixed income, you want to be in a state that has no state income tax. And it's cheap. And it feels like a vacation. So you can be in warm weather and in Florida, you can still even live in a beach town if you can deal with hurricanes. and live like you're on vacation and not pay that income tax. So we're seeing massive migration there. But you can see also, Colorado, of course, is doing great too, and in the Northwest.
What's going on in North Dakota?
That?
Oil.
Yeah, oil. Yeah, oil. All right, this is the U-Haul traffic flow chart. I'm sure you've probably seen this, but basically haul tracks where trucks are going, where most people are moving. Number 1 is Texas. Number 2 is Florida. Colorado is number 9. What's number 50? Can you see? My state, California.
Welfare state.
Pretty much. Yeah, welfare state with the most expensive houses is a bad combination. So these are just some of the areas that we look at. Denver used to be on the list. Prices are going up. It's harder to get cash flow. But if you are really seeking cash flow today, these are just some of the areas that still offer double-digit returns. Sorry, I keep getting in your way. We like to look for cities that have some of the same characteristics that Dallas had 10 years ago. Now, nothing's really going to compete with Dallas. It is a winner, a racehorse. Yes? Huntsville.
Texas.
Alabama. I mean, Dallas has just, it's a machine for the U.S. economy. And Dallas had, Texas had the right idea. They went through a massive S&L crisis in the 80s. They went through an oil crisis. They went through a recession when other states weren't. And their leadership came in and said, all right, well, that's never going to happen again. We're never going to be dependent on one industry, gas and oil. So they changed everything and made Texas incredibly attractive to do business. And they're like, how do we become more diversified? I know, let's make it a good place to do business. And that's what they did, and that's kind of why we started buying it back in the 90s, and then certainly in the 2000s. You got tax breaks for moving your business to Texas, and lots of tax incentive, and it worked because lots of businesses moved there and are still moving there. And when businesses are there, people are there. So job growth, population growth, and then tons of infrastructure development, which creates more jobs. So, but prices have gone up in Dallas. It's harder and harder to get this kind of cash flow if that's what you're looking for. So we look for other cities that are doing something similar, maybe not as massively as Texas, but similar. So it would be areas that are revitalizing themselves somehow. Maybe they've suffered from a bad reputation, but they want to change that. And that's really the opportunity. If you're looking for cash flow and appreciation, which is what I want. I'm from California, and I love, like I said, the first house we bought, paid $500,000. 10 years later, it was worth $1.8 million. I like that. If I had sold it, I would have liked it better. So I don't like just buying cash flow. I want to know there's going to be a kicker on the end. And so these are areas that we see are doing some of this revitalization that maybe suffer from a bad reputation. Like, has anybody been to Pittsburgh lately? No? Do you have, just tell me, just throw out some things, ideas of what you think Pittsburgh might be like, based on what you know about it. Industrial? Dirty? Yeah, it's got a bad reputation, and it's true. I mean, you had to, if you lived in Pittsburgh when it was really a steel town, every morning you'd have to go out and sweep your porch because it's covered in dirt. That's like inches of just nasty dirt and toxin. It was probably the dirtiest city. The river was toxic. And today, my daughter's actually in Pittsburgh right now. It is one of the top green cities in the U.S. It leads the country. It has one of the top LEED certified buildings there, office buildings. The river is clean. People are water skiing in it. There's boats out there. It's considered one of the #1 places to meet for singles because there's bars all along there and they're partying in the boats. It's a fun town now, and guess what? Some of the industry is there. It's not steel. No longer a steel town. It's like high tech, and you won't believe this. I'm from California, so a lot of times people don't believe it. It is second to Hollywood in film production. Pittsburgh, Pennsylvania. Isn't that weird? But for the same thing, they decided to create tax incentives for the film industry, and Atlanta is too. So, but the reason we like Pittsburgh is because it's still cheap, so cheap, and yet all this redevelopment happening, and a lot of young people moving there because it's become a cool place. Lots of bars and restaurants and Steelers and all that, So we want to know that a city is redefining itself, but the rest of the world hasn't figured it out. Because here, if you don't know it, that means probably foreigners don't know it. Because where are foreigners investing? In cities they know about, right? They don't know about Pittsburgh, but they're going to be investing in LA and Seattle and probably Denver. They know these cities. Pittsburgh just sounds like a dirty old town, but they don't want anything to do with it. But if you go there, you'd be shocked. We bought a 50, let's see, I think we paid like $50,000. Oops, I don't know what just happened. Maybe okay. There, thanks. Back. There. We bought a $55,000 duplex like 3 years ago, and put about $30,000 in, so about $85,000 total. Literally, like a 2-minute walk from a brand new Hollywood film studio that they're building, and we got tenants in there paying $550 on each side that have a 5-year lease. So, these are the kinds of opportunities you can get. I wouldn't buy that duplex if that film studio weren't going in, because I'm not into just cash flow. I want to know something's happening. And then another block from there, Warren Buffett put in a new CSX headquarters, and just lots of development happening. So I know my little duplex is only going to gain value while I'm cash flowing on it. I like that. I want to cash flow and then make a bunch of money at the end. That works for me. All right. So that's one of the reasons I like Pittsburgh. I'll just kind of quickly go over these other ones. Birmingham is having a lot of redevelopment there as well. Beautiful new downtown. Chicago is the 3rd largest city in the U.S., but still you can get houses for under $150,000 in the suburbs. It's a little iffier because Chicago has some laws I don't like, and they've got massive pension problems. So you have to have guts to go and invest in Chicago. Higher crime, and there's issues there. But at the same time, if you can get in front of the path of progress, you could see cash flow today and equity growth in the future. Is there something like, I don't know, 60 high rises going up in Chicago and massive growth, and yet just in the suburbs nearby, you can get homes for pretty cheap. So again, you have to have a certain kind of personality to go for that. Cincinnati and Cleveland. Cleveland is a city. Once again, anybody been there lately? You would be shocked what's happening in Cleveland. You got to just look it up. It's amazing, and it's important to understand that we got a lot of us are aging. We don't want to. We want to stay young forever. Cleveland has become one of the number one medical communities. If you look up Cleveland Clinic and the Cleveland, if you just look up Cleveland healthcare and medical, it's like a whole city is medical. It's unbelievable. It's beautiful. They have massive conferences there. People come from all over the world. Cleveland is the center of this. And so just look up Cleveland Clinic. And yet you can buy houses for $100,000 nearby and rent it to a medical student. There's like 5 different universities there just for medicine. And so we bought a house for about $55,000. You can't get this today, but just to show the trajectory, about, again, 3 years ago. And no, we paid like 30 and put 20, so we bought $55,000 all in, got a renter for $950. He's the same guy for 3 years, and he's like a doctor or something. So you're like, why doesn't he buy his own house? I don't know. I don't care. He's a great tenant. It's wonderful. So, again, learning about what's happening in our country is so important. You just have to get over the fear of investing out of state, which I'm sure you have lots of questions about. Huntsville, Alabama. The reason that's on the list is does anybody know what's happening in Huntsville?
Well, it's big government, NASA.
Yeah. Aerospace. You will rent your $100,000 property to a rocket scientist. I'm not kidding. Yeah, it's cheap houses and lots of money going there, because guess who's president and guess who wants to have NASA grow? So you're seeing that city really, it's I think one of the most, I think it's the highest degreed citizen. So they have the highest college degrees in Huntsville. Again, things you might not know. I could go on and on about all these cities, but lots of, Columbus, Ohio. You know what's going on in Columbus? It's like the fashion industry. What? Ohio? What do they know about fashion? But apparently they're the headquarters of, what is it, Abercrombie or something? I don't know. Jeans? Yeah, I don't know. But they have college there, university. So you get homes for $100,000, and they rent well. So, all right. I know there's a lot of multifamily people, and I'll move through this quickly, but I do want to say, I know that there is we're all getting to a point where we want to retire faster, and I do still love single family homes because I think when the millennials come of age, the largest group of them are still around 25. The home buying age typically is 31, but the millennials are delaying it a little bit, so maybe it'll be 32 or 33. But the largest group of millennials is around 25 today. So in about 7-8 years, when they're ready to buy, there could be a huge housing boom. And how nice if you could be the one that owns the house they want, in 7. So you rent it now until they're ready to buy. So I do like single family homes. I know some people don't think it's as interesting as other asset classes, and I understand, but this is a strategy that I think is very helpful if you're trying to figure out how to have a retirement in 10 years or so. If you need about $200,000 for this plan, and you need good credit. But basically it looks like this. You buy 10 $100,000 homes on your credit. You can get Fannie and Freddie loans and lock in these 5% interest rates, or they're going up, but they're still low historically. And if you can shoot for a $300 cash flow with 20% down, and you have 10 homes, because Fannie and Freddie will let you have that, again, locked in for 30 years at that payment, then you'll have about $3,000 a month cash flow with that $200,000 investment in these 10 homes. You start with one, you don't have to buy 10 all at once. But if you have $3,000 a month cash flow after all expenses, that's $3,000 for all 10, right? And 36,000, I think I'm getting this right, 36,000 at the end of the year. If you were to pay off your first house, if you were just on an accelerated plan and you wanted to retire soon, and you took all the cash flow from all the properties and paid off that first house, how quickly could you have it paid off? A little over 2 years. You have that first house paid off, free and clear. Then you take all the cash flow, you have more now, because no more debt on that one. You pay off the second and the third. And then when you accelerate payoff of loans, you can pay it off in half the time. And if you really accelerate like this, you can have these 10 homes paid off in less than 15 years, and maybe as short as 12 years as rents go up. Your payment's locked in, but your rents are going up. So there's a chance you could have all 10 homes paid off in 12 to 15 years with this plan, and now you have $1 million portfolio, free and clear, and with about $7,000 in today, is coming, and with the tax write-offs that you'd be getting, these homes could be worth $2 million or maybe $3 million. I don't know in 12 to 15 years the kind of inflation we're going to be seeing. But what we know is that they'll probably be worth more, based on what we're seeing. Just the cost of supplies and labor to build that same home. It's going to be very different. So that is just one way to, have a retirement in addition to what you may be working on. And then these are more of the growth. Oopsie, I don't know why I keep doing that. If you're, not interested in some of those tertiary markets like I showed, and you want to be in the markets where more people are moving, you're going to get a lower cap rate today. And that's a bummer, because back 10 years ago when we were buying in Dallas and Houston, we were getting double-digit returns, and now you're lucky to get 5 or 6% in finance, really not that much better. But if you really want to be where there's larger populations and where people, obviously you saw the charts where people are moving, these are still good cities, just not nearly as good a cash flow as before. But we have a lot of investors in California who don't care. They're like, I don't care, I'm getting nothing here. You could sell, maybe they bought a $500,000 condo 3 years ago, now it's worth $1 million, and they're getting $3,000 a month. They're so happy to sell that $1 million condo and buy 5 properties or 7 properties in Orlando, and to diversify, get out of the earthquake zone, and still get much more cash flow in California. It may not be as good a deal here because you're here and you don't have the same problems we have in California, but you're getting them every day. So anyway, these areas might even be cheaper than here. And then the second opportunity that we're seeing for sure is supply, and that this is one of the ways that we're syndicating. We're partnering with builders who have 30 years experience at least, and just building, raising money and building. But I'm going to talk about how to do that safely, because it was really builders who got hit the hardest in the last downturn. I mean, they just got wiped out, and you do not want to be that builder. But if you can get in and build supply, there is an incredible opportunity to do that. These are model homes at our Reno project. And again, Reno, Nevada. Who thought that would be booming? But Tesla moved there, and Apple just moved. Amazon has some offices there, and high tech, and lots of things happening. Massive growth. They need 3,000 new houses this year. No, I think it went up to 7,000 houses, and I think 800 were built. So we just released our first phase, and we were going to start at what would be considered affordable, which would be 400,000, because these are engineers coming from San Jose that are paying $1 million for nothing. So $400,000 for one of these. But now, I mean, we're selling them for starting at 6 and up to $1 million, and first phase sold out in Reno, of all places. I mean, it's amazing. So building can be quite profitable today, but you want to make sure you have lots of experience, or you're working with someone with experience, because it can be tricky. All right, so we talked about strengths, weaknesses, opportunities, and now threats. So, and I know there's a lot more opportunities, obviously multifamily and private lending and syndicating, there's lots of opportunity out there. Just gotta know what the threats are so you do it right and you don't get stuck if things turn. So you remember I showed the unemployment rate, and we're at new lows. But what if you look closer, while that's been touted as a really positive thing in the headlines, what's a little bit scary about it is that look at the cycles. These lines are recessions. And what do you notice as a pattern when unemployment rate hits a low?
Recession starts
right afterwards. So it's just a chart, and it doesn't necessarily mean anything, but typically what happens in this part of the cycle is exactly what's happening, is that you have such low unemployment that the country is stimulated, right, with massive stimulation. So now the Fed is putting the brakes on. And the Fed puts the brakes on. And the Fed is what manipulates our economy. You've got to pay attention to the Fed, which I'm going to talk about in the next slide. But every time unemployment gets this low, the Fed brings on a recession. And if you're in an apartment or any kind of commercial building, and you know that you're locked into a low rate, but you're going to have to refi, and the note balloons, and you got to get a new rate, what happens if you have higher payments? What happens to your NOI? What happens to your cap rate? Changes. And the value of your property can decline, and sometimes you have to come in with a whole bunch of cash. So as a syndicator, you've got to be aware of this, because syndication is really, really fun when everything's going great. It's really not fun when it's not. And you're responsible. You're responsible. It's an LLC, and you're protected, but you're also not. You're leading the charge on that, and you need to make the right decisions. And one of those decisions is making sure you've got your debt handled. One of the reasons why Real Wealth Network gets great deals lately is we're buying deals from other syndicators that went down, where investors lost money. But the Reno deal, these guys bought this amazing land, just an unbelievable parcel of land that's flat, and Reno's all in mountains. You know what that's like, so it's hard to build. But this land is flat, and it's right off the freeway, and there's no infrastructure. I mean, it's incredible land. It took them too long to entitle it, and they had to get a hard money loan, and the loan was due. We came in and we bought that land, and their investors lost money. So our investors get the gain, their investors lost. So you got to be careful. Debt will take you down. You've got to have good debt, especially with the environment that we're going in. I'm not against debt, but have the right debt. Be careful of that, because short-term rates are going up, and it looks like that's going to continue based on some of the things that we're seeing. And long-term rates going up too, which is why I love single-family homes, because you can lock in those 10 rates. You can lock in 30. But you can get 30-year rates now on apartments too. So definitely look into that. All right, I don't know how much time I have.
We're about ready to wrap up.
Wrap up?
Your questions.
Okay, all right. So just to leave at this, that the money supply is the most. Like I said, what the Fed is doing is the most important thing to pay attention to, even more important than any policies that you're seeing. Because if you think that the boom that we've been seeing is because of any kind of policies that politicians are talking about, it's not that, it's this. When you print $4 or $5 trillion and throw it in the economy, you better see something happen, right? You better see prices go up. This money supply, this is how much money was created out of thin air and thrown into our economy. This is how it used to be. And the only reason that the Fed can do this is because in 1971, Nixon took us off the gold standard, and suddenly we didn't have to have our money tied to gold. The dollar became the gold standard. What? A piece of paper became the world's standard. And so guess what? We abused it. And we just print it like it's paper. And this is what we did. And so this has never happened. And so this is what all this boom is about. And guess what? They're reversing it now. They're reversing, they're tightening, they're taking money out. That is going to affect the economy, and we've got to be aware of how that might affect. So with that, I know you're Colorado people, so you can relate to this. It's really fun to go whitewater rafting, and the journey it's different depending on how much water is there, right? My husband likes to go when they open up the floodgates, and it's a class 4 or whatever, and it's crazy. And some of the things the rocks and things, and the way the water flows is different than when I go, which is not class 4. I go when there's less water. And so, the way the ride is going to depend on how much water. It's the same with the money supply. The way the journey is going to be very different now. It's a different game as it tightens. And so, you want to understand that and have a good guide so you don't end up like this. If you're going to go whitewater rafting, you want a good guide, right? If you're going down it the first time. So make sure that you're really with people and doing, partnering. If you're new, you haven't been through market cycles, make sure that some of your mentors and friends and people you hang out with have been down this road before, down this river. Because a lot of people think, and they're out teaching and they've only been in the game when the water was high. They've only been in it for the last 10 years when things have been great. But talk to people who went through the last crash and the crash before that, and you'll get some really, really sage advice. So what do you do? What do you do? Again, I know I got to wrap up. Just make sure you're positioned for either way. Like the Reno project, I'll just tell you really quickly because we syndicated it. I raised $16 million. I know that's a lot, and we have a system for that, but we bought all the land, we finished the entitlement, it was already entitled, and then we sold this blue piece off for the same price that we paid for the whole thing. So now we are left with those light blue and orange lots free and clear. If there is a recession, we are not the ones going down because we don't have debt. And then we're going to build the houses, and with each house, the money that comes from the sale will build the next. So this is one way you can move forward with confidence, knowing that your investors are safe, that your money's safe, and that no matter what happens, it's going to be okay. So we have to say there's a recession, we have to sit on the properties or lower the prices, it doesn't matter. We're in it at such a low cost. And these are, the way some of them turned out, that we just had our open house. And then one last thing, this is property we raised again, I don't know, it was $4 million to buy 800 acres of fertile property in Costa Rica. Again, all cash, and this is helping our investors diversify. And then in the meantime, while we're getting the houses built, we put in all these tents that's called glamping, like glamorous, you guys know it, you're Colorado people, glamorous camping, glamping. So we got all these, nice, fancy air-conditioned tents, and we're cash flowing on the property. We're already turning it into a retreat center, which is the plan for it, but we are already cash flowing so that we're not just sitting on land, and we own it free and clear. So again, these are ways you can be bold in an uncertain market and protect yourself and your investors and your money. So this is where you can find me. The Real Wealth Show, Real Estate News, Retire Rich with Rentals is my book, and you can join realwealthnetwork.com for free for more free education and updates and to find out about our different deals. Thank you so much.
have time for 4 questions. I'm going to give you the mic if you have a question, so you raise your hand now and I'll come to you.
What coast is your Costa Rica retreat on?
Yeah, we have, we're on round 2, syndicating this deal. It is right next to the fastest growing city in Costa Rica called Saint Inez.
Is it on the Caribbean or the Pacific?
It's an hour inland from the Pacific side, yeah. So it's up a little bit elevated because it's not as hot and there's not bugs up there and anything, but we've planted 10,000 organic trees and it's like this really cool sustainability retreat center. So cool. It's about an hour inland from Jaco.
Okay.
Yeah.
And so it's right where that building, the new highway from where they're going to move.
Lots of new infrastructure, brand new airport going right there. I mean, this is going to be in a way to diversify. Yeah.
Next question, raise your hand.
We're pressed for time. I really appreciated the podcast of yours that I've listened to that talked about your difficult times and how you got through those with your family. So thank you for sharing. Do you have any words of wisdom on how you tap into resilience when you're at your rock bottom on a given day or time?
Oh my gosh, yeah. So what she's saying is that my husband came home 13 years ago and was told he had 6 months to live. He had melanoma and they thought it spread. And I mean, I just can't imagine being told that. He is fine and the doctor was wrong, but at the time I didn't know. So for me, total denial. That's how I got through it. I was like, the doctor's wrong, you're fine. But I have had my first syndication. Investors lost money. I mean, I've been through hard times for sure. I found that honesty was the best way to deal with that if you're talking about investors. I just went to them and said, you know, it just didn't work out the way it's planned. I actually started crying on the phone call. I don't recommend that. But the more honest, the better, because the lack of communication is usually the thing that causes problems. If we can work together and just be honest, and people will show up and help you. And then just just seek help. Seek help. And usually that person will show up who is just the person you need. And lots of exercise, good food, and sleep.
All right, 2 more questions. Here's one.
Kathy, thank you so much. I've been following you for a little while. One thing that has kept me in multifamily instead of going to the single family market is the ability to qualify. My husband and I can buy 100 units apartment complex easier than I can buy my 3rd single family. Any strategies on how we can get over that hump of, you only have so much in a W-9 income or a W-2 income. And anyway, I'm just not sure how to do that.
I think multifamily is a great option. It's just not my strength. We happen to be set up with single family providers nationwide, and that's just what we're good at. The way that we are working, we're starting a Reg A, so that means that we can take investor money as little as $1,000 for anybody. They don't have to be accredited. It's almost like a small IPO. So for us, that's one way. It's basically OPM, finding a way to get other people's money to invest with you and partner with you on whatever deal it is. And usually there's people out there who have money and no time. And if you've got the time and the expertise, you could partner. So again, that's just one way, but it doesn't have to be in single family. It's whatever asset class that you're an expert in. Yeah.
One last question, raise your hand.
Because I'm an investor, I get hit up so many times over this Bitcoin thing. And of course, Mr. Wonderful and Shark Tank, he relates Bitcoin to real estate, so I wanted to get your thoughts on that.
I did a few shows on Bitcoin, and I've learned over the years to not do anything I don't understand, and I've lost money doing things I don't understand, so I just don't get it. But at the end of the day, our money that we use today is pretty much just digital anyway. And the banks, the way I look at it is the Fed controls the world, the banks control the world, and they are not going to allow something to take that power away from them, in my opinion. So all the ideas that your money's hidden and all the reasons why people do Bitcoin, I think I would challenge that, because I don't think the powers that be are going to give up their power that easily.
Thank you so much. Give her a big round of applause.